Hey guys, welcome back to the channel. So in today's video, we're going to be talking about financial literacy and things related to it. Okay, so this is the content. So what it is, definitions of terms of the financial literacy, dividend, shares, and related. So we're going to be talking about the definitions of these terms. Okay, the dividend, about shares and stuff related to them. So first of all, financial literacy is just a skill and knowledge that you need to be able to manage money and debt effectively. Okay, so generally a director need to have these skills. Okay, they need to know these terms, the definition of the terms, to be able to manage money and debts effectively. Okay, so diving in, we have the definitions. These are pretty basic definitions and everyone needs to know this. Okay, so wages is just money per hour received by an employee. Okay, so this is a rate. Okay, wages is a rate of money per hour. Salary is pretty much wages, but it's over the year. Okay, so the time difference is year. Salary is year per year, money per year, and wages is money per hour. Okay, so fees is a generally really broad term, and uh these are you can subdivide them into different types of fees, like this admission fees and higher fees right here, but we're going to be talking about these two main fees later. So fees is just money paid for services. So you pay people to, clean the shoes for you, pay people to wash your cars for you, something like that. Okay, so fees is just money you pay for services. Commission is okay, so if you're talking about the point of view of the person who sells something for you, they receive commission. Okay, so commission usually is expressed as a percentage. So let's say real estate agents, they help you sell your houses, and they normally get around 1 to 2% of the house price when they successfully find a customer or a buyer of your house. Okay, rent is a type of fee, but this is tenants. Okay, they pay to house owners for letting them stay at the house. Interest is just the additional money on top of money borrowed. So let's say you borrow $10,000 from the bank, and the interest is 10%. So every year, you let's say 10% every year. Okay, and you're talking about simple interest and compound interest. Okay, these are two different types, but I'm not going to delve too deep into them. I'm just going to talk about interest. So it's just additional money on top of money borrowed. So as I said earlier, an example is $10,000 you borrow from the bank, and 10% each year, which is really high. So 10% of $10,000 is $1,000. So after 1 year, you have to pay 10,000 $11,000, and that $1,000 is going to be your interest. Admission fees is just money paid for owners to let you see their things. For example, museums, you pay tickets. Okay, so tickets, the cost of the tickets are admission fees, so they let you go inside the museum and see their stuff. Higher fees is just the money you pay to hire or to borrow equipment. Okay, for example, this can be not just equipment is quite specific, but this can be vehicles too. So let's say you hire a car for the rate of, let's say, $30 per kilometer or $30 per hour. So that $30 per hour or kilometer is going to be your higher fee. Royalty is just money paid for owner for letting people use stuff. Okay, this is pretty much kind of like higher fees, but this is applied to specific individuals, like book writers or novelists. Okay, so at a book sales, the publisher will publish the author's book and then sell them at the book sales. And for every book they sold, like a percentage of money of that money is going to go back to the author. Okay, the owner. Similarly to an artist. Okay, so they produce music, and every time you play their music, like part of you have to pay a part of that money. Okay, so like probably 2 to 3% of that of the amount of that specific song or a book and you pay it back to the owner or the author or the artist. Gross income is pre-tax income. So, for example, income can be found by taking revenue. Your sales is your gross sales is like the top margin money you'll get for that year. So gross sales or revenue minus the cost of goods sold, which I'm going to be covering it in the income statement video. But cost of goods sold is just basically the money, the cost of your goods that you're selling, plus the purchases, plus the delivery cost and the production cost, all that stuff, and you have to minus off expenses too. So generally, the equation is going to be um, revenue minus cost of goods sold minus delivery cost minus expenses, and you get your gross income, so the pre-tax income. So before you pay tax, and net income is the post-tax income. Okay, dividend, shares, and related. So now we dive into dividend, shares, and related. So you have three different types of dividend policy. So the first one is stable dividend policy. So no matter what the company's earning that year is, or no matter what the profit is, there's going to be a stable amount of dividend per year for the shareholders. Okay, so for example, the owner promised, okay, according to its dividend policy of the company, the owner promised, let's say, there's going to be $10 per share every year, no matter the change. So even if they're losing money that year, or even if they're making billions of dollars, dividend is still going to be $10. Constant dividend policy is pretty much the opposite of stable, where dividend fluctuates. Okay, so it depends on the income of that particular year. So if the income is high for that year, then the dividend per share is going to be high, and vice versa. Okay, so a residual dividend policy is when dividend will be paid out. Okay, so it's pretty much constant dividend policy, but you have to minus off working capital if the working capital is negative. Okay, so working capital is current assets minus current liabilities. So if the current assets is bigger than current liabilities, then you're absolutely fine. Okay, you don't have to pay working capital, but working capital just shows a business ability to pay its short-term debts. Okay, so if its current assets exceeds its current liabilities, then you're good to go. But if it's less than current liabilities, then you may need to consider investing in that particular company. Okay, but it just shows how, if a company is able to pay its short-term debts or not. And you take the dividend amount, you take the money, you minus off the working capital, and you also minus off the capex or the capital expenses. Okay, so the money needed to acquire, upgrade, and maintain its physical assets. For example, you need money to buy new factories to produce your stuff. So that the cost of that factory, the cost of setting up one is going to be in your capex or capital expenses, and the company needs to take a part. Okay, so they will retain money back to build a factory, or keep its assets back. Okay, so after all that stuff, the remaining amount will be your dividend, total dividend, okay, of that company. Okay, so here we have retained earnings. As I said earlier, it's amount of money a company keeps back for future uses. You can use this to pay capex from the residual dividend policy. You can keep back to pay working capital again from the residual dividend policy, or you can just keep money back to pay for future dividend. Okay, so let's say you predict that your company might not make a lot of income for the next year or so, and your dividend policy is not a stable one, so you need to keep your money back, or whatever. Even if the dividend policy is still stable, you need to keep money back to pay for your shareholders, because you're not going to make a lot of money next year or the years after. Okay, so dividend, now we get to the basic stuff, is the money of shareholders, that they get, okay, based on the total profits of the company. Again, it's based on the type of dividend policy, and this equation right here, money for shareholders times, this right here, money for shareholders divided by time based on total profits of the company, is just for the constant, and the residual dividend policy. The stable dividend policy is just the money is just going to be the same all year round. Okay, so the calculation for this, or the equation for this, is you take the prior year retained earnings, you plus net income this year. Okay, so retained earnings is above here. So last year, you keep back this much. Let's say, for example, here is $12 million. Okay, and then you plus the income this year, which is going to be $15 million, and you minus the retained earning this year. Okay, so you keep back this amount of money, $12 million again. So the total dividend that will be paid out is going to be $50 million. Okay, so capital gain is just money from buying or selling properties or shares. Okay, it can. Okay, so this one is the equation for the shares. Okay, and it's the equation for the properties is pretty much similar. So for the shares one, so you take the new share price minus the original share price, then you get the difference between them. So the difference is called capital gain. Similarly to properties, you take the new price of that property minus the price you bought it for, or the original price you bought it for, and you'll get the difference between the two, and it's called capital gain. Okay, so if the capital gain is a positive number, then you've made some profit. But if it's not, then you've lost money. Okay, so an example here is NSP new share price is $50 per share, and OSP is $40. Okay, so original share price is $40 per share. So the capital gain is going to be $10 per share. All right. So continued on, we have return of investment. Return of investment is just you calculate the ratio between your capital gain and the share price, or the price of the property, or the specific property that you own and you're about to sell them out. So it's typically shown as a ratio, but people also show it as a percentage. So the equation is capital gain divided by share price, the original share price, okay, or capital gain divided by the original price of the property. An example is capital gain is going to be $10, share price is 100, so the return of investment, or ROI, is going to be 0.1 or 10%. Dividend per share is just how much dividend you'll get per share that you own of a particular company or specific company. So the equation is total dividend, total declared dividend, or total dividend of that company divided by total number of outstanding shares. And what outstanding shares really are is just the shares that are public. Okay, so shares that are available for people to buy them. So it's in the market. What I mean, why is there outstanding shares? Because the owner or the founder of the company might keep back some of the shares for themselves, so they will not be posting. Let's say a company has 12 million shares. That's the total number of shares. But the co-founders keep, all the founders or the owners keep back, let's say, 2 million shares. So the outstanding shares is just only 10 million shares. Okay. So an example, coming back to dividend per share, dividend an example is total dividend is going to be 10 million that year. Total number of outstanding shares is going to be 5 million, and so the DPS is $2 per share. Earning per share is similar to dividend per share, but it doesn't show how much you get from a share of the company, but it shows a business potential to pay dividends. Because again, as I said, earnings is not dividend. Earnings, you have to subtract all that. You have to subtract retained earnings. You have to subtract cost of goods sold and expenses before you get to the dividend. Okay, so it's the wider step, or the broader step. So it shows a business potential to pay dividends. So the equation is going to be total profit divided by number of outstanding shares. So for example, you have $12 million is going to be your profit, and the number of outstanding shares is 24 million. So your EPS is going to be $0.5 per share. Price to earning ratio. So it's share price divided by EPS, or earnings per share. It just shows, how much you have to invest in the company to potentially, this is important, potentially receive $1 from the company's earning. Why potentially? Well, potentially, again, it's really based on the type of dividend policy that the company has. If it's stable, then you don't need the potentially. Okay, so just cross the potentially out and just the company to receive $1. But if it's constant or residual dividend policy, then potentially it's true, because the income of years can fluctuate, and so does the dividend of that particular year. So it's just potentially receive $1. Okay, you might not receive dividend that year at all. So just a saying potentially is really important in this context. And an example is you take the share price divided by EPS, $10 divided by zero point 0.5, then you get $20. So you must invest in $20 in that company to potentially receive $1 from that particular company. Dividend yield shows the percentage of share price. The dividends is paid to the shareholders each year. So it's dividend per share DPS divided by share price times 100. An example is DPS is $2, share price is $10. So the dividend yield is going to be 20%. So the dividend is only 20% of the share price of that a particular share of a company. So market value of a company is just shows how much it is worth. So it's just share price times the number of outstanding shares. Example is you have the share price is $20 and the number of outstanding shares is 12 million. So you have $240 million. So your company is worth $240 million. Okay, so net tangible assets. Okay, so it shows the value of non-physical. No, okay, I'm sorry. Net intangible assets shows the value of your non-physical assets of a company. An example is goodwill and copyrights. Okay, so the equation is going to be market value minus equity, or equity is just assets minus liabilities. So market values minus the book value of a company, or the equity. That's the equation. And you have market value here, an example of $12 million. Equity is $11 million. So your NIA, or your net intangible assets, is going to be $1 million. Similarly to the tangible assets, the equation is going to be different. So it just shows the value of physical assets of a company. Okay, an example is PP&E, or uh, property, plant, and equipment. Okay, so it's just how much your car is worth, how much your buildings are worth, how much your let's say land is worth, how much your delivery team is worth, something like that. The equation is going to be total assets minus total intangible assets. Or so you have to find your total intangible assets. You have this up here, and they're basically the same. Okay, so net tangible assets and total intangible assets are the same. So you can substitute the total intangible assets with this equation up here. You minus off total liabilities, and you'll get the net tangible assets. An example is total assets going to be $50 million. Your total intangible assets is going to be $2 million. Total liabilities is going to be $3 million. So your NTA is going to be $45 million. So proceedingly, you proceed further. You have NTA per share, which just assess the financial strength of a company on what it owns and what it owes. So it's just basically how much money per share of the company is a particular net tangible assets. So it's NTA divided by total number of outstanding shares. So it shows the how much tangible asset is in a share. So let's say NT is $15 million, and your TNOS, total number of outstanding shares, is $5 million. Your NTA per share is $10 million. Okay. Yes, that's going to be the video, and thank you for watching, guys. Tune into the next video for